Order, and welcome to the Treasury Committee's evidence session on your recent monetary policy report and financial stability report. Can I ask the witnesses to introduce themselves, starting with yourself, Governor?
Andrew Bailey, Governor of the Bank of England.
Elisabeth Stheeman, external member of the Financial Policy Committee.
John Cunliffe, Deputy Governor for Financial Stability.
Thank you.
Swati, Dhingra, external member of the Monetary Policy Committee.
Thank you very much. Well, I'll start, if I may, by asking the Governor, clearly inflation, which is such a terrible tax on our economy and particularly harms those on the lowest incomes, is still far too high for any of us to feel comfortable. And I know that over the summer you announced that you have asked Ben Bernanke, the former Federal Reserve head, to lead an investigation in terms of your modelling and, as I understand it, related processes. Can you tell us when you're going to publish the terms of reference, Governor?
Yes, I can. Thanks, Chair. So I should say, of course, it's the court of the bank that
it is the court of the bank. Yes,
I think I can speak on court's behalf.
Yeah.
So yes, so Ben Bernanke is already engaged in the work, and we wanted him to be engaged before we finalise the terms of reference to get his input to the terms of reference, which is very valuable. Court is meeting on the 22nd of September. I expect that they will finalise the terms of reference at that meeting and publish them shortly afterwards.
Okay, thank you very much. And then in terms of the modelling itself, one of the factors that I think we were surprised to learn about when we last heard from you and from the Chief Economist, Hugh Pill, was that the modelling had something of a recency bias built into it, looking at the years since you've been independent. And that the 70s, when we last had a big energy crisis, didn't seem to necessarily be something that would be captured by the models. And then Hugh Pill sent me a long letter in June, and there was one paragraph where I wasn't entirely clear whether he meant that this had been implemented or whether it was something that had happened some time ago, which was around incorporating the information from the 70s and 80s. So on page 6 of his letter, paragraph 2, he says the bank staff have adopted an approach where they look at the academic literature and some of the surge of inflation that happened in the 70s. So could you just update us when that started to happen at the bank?
Well, to put it into context, I would say again, there isn't a single model. So we have what we tend to call a suite of models, and that's deliberate because to rely on one model would I think, be a mistake. The reason I think, as Hugh said, that we tend not to use data from the 70s is because, amongst other things, the macroeconomic policy regime was very different then, and so the reaction functions of policy were very different. However, I think the point that Hugh was making, and there isn't a single date for this, that of course in the work we do, and the work the staff do for us, and the staff obviously do a lot of work, and they estimate new models regularly in doing that work. They can, of course, go back and look at the 70s, and often, I'm sure will go back and look at the 70s, and sometimes they'll estimate things using
Can you clarify whether the Monetary Policy Committee in your deliberations since the invasion of Ukraine spent time talking about what previous energy shocks had done to inflation?
Yes, we have certainly looked at the previous energy shocks. So to give you...
You discussed them at
well,
the
let me give you one example,
meetings.
which certainly, this is from my own my own thinking on the subject. We've talked once or twice, I know, in the committee about this question about the distributional effects, what I call the labour share and the profit share. And it is useful to go back and look at the 70s in that respect and to contrast and compare what we're seeing today in terms of the moves of those shares with what happened in the 70s. Now, actually, it was quite different, what happened. But of course, even though it's different, it's interesting and informative to do that, even though we may conclude, well, that was a different story.
Because I noticed in the Monetary Policy Report that you've got some new analysis, and I'm quoting from the report. There are non-linearities in the way inflation is reacting to changes in demand.
Yes.
The response is greater when spare capacity is more limited to begin with, end of quote.
Yes.
I mean, that seems like a fairly obvious insight and one that we learnt from the 70s and 80s. And was it one that you think perhaps had been forgotten by the Monetary Policy
Well,
Committee?
I think it is interesting, but let me add the caution, just to go back to make the point I did, that when we look at the responses of inflation now and then, there is the important difference that the responses now are within a framework and a regime of inflation targeting, whereas they were not in the 1970s. And that, of course, is an important difference in terms of judging and comparing and contrasting the responses. So I think it's interesting to look at, but I would just always draw this cautionary note that without that, what I might call anchor of the regime, you will get you will get different outcomes and different processes.
Well, we did our own sort of external review. We invited in some experts.
Yes.
I'm sure you've read the transcript from
Yeah.
the 5th of July. And we did ask them about these sorts of issues. And one of the things that they highlighted, in addition to the modelling issues, where you, as you could say, the court have established a review, some of the concern was around that recency bias and the fact that there seems to have been a de-anchoring, because anchoring will only work if the public trust you to manage to achieve 2% over time. And there does seem to be, certainly in terms of the strike action, the wage demands that we're seeing across the economy, the high level of private sector wage increases, that basically the public have given up on hoping that the bank will get inflation back down to target in any time soon, and they've demanded those pay rises, which is causing second-order effects in terms of inflation.
I would tell us, if you don't mind, I would tell a somewhat different story around that. As we've said before quite a lot of times, there's been a very big terms of trade shock in this country, which has affected national real income. That inevitably gives rise to a distributional question. It's not, of course, for us in the MPC to determine the outcome of that, but it inevitably gives rise to that question. And I think that is, of course, what we're seeing in terms of wage bargaining. The issue, I think now, and this is a very important question for where we are now in terms of policy setting, is you're right that when I look at it today, many of the indicators are now moving as we would expect them to move, and are signalling that the fall in inflation will continue. And as I've said a number of times, I think will be quite marked by the end of this year, further quite marked by the end of this year. However, the wage bargaining, of course, is one thing that has surprised us the other way in recent months. And the question now is, as headline inflation comes down, and I hope people become more confident that it's going to continue to come down, because it's now come down quite noticeably, but there is a long way further to go.
You don't accept that expectations are de-anchored?
Can I just, what I'm saying is, will we see inflation expectations continue to come down, because we have seen them start coming down, and will that be reflected into wage bargaining? Now, if I look at the decision, the DMP survey, the decision makers survey that we do, and we ask firms in that survey, what is your expectation of wage settlements for the next year? It has started to come down. So the latest figure is, I think, 5%. It was 6 something.
5% is
earlier.
2.5 times your
Yes,
target.
but my point is that's
not
as
a
no, hang on,
de-anchoring.
but
I
that's
don't
my
know
point
what it
is this is as expectations of inflation coming down become more embedded. Are we going to see that continue to come down? Because it is on a downward path now, and the question is, are we going to see it continue to come down? And that's important for our policy decisions, now, because that's what shapes a lot of our thinking about the direction of policy now.
Mm. Well, we've talked about the modelling and the steps that you're doing to look at the range of models that you have. We've talked about some of the recency bias and the fact that you are wedded to this period over the last 30 years, but that you're bringing in some of the information from other periods to inform your thinking, perhaps more recently. I'm not sure I was completely clear when the committee started talking about it.
Just on that, there is not a single point in time, because the staff do a very large amount of work for us for every round of the MPC. and they will use different periods of time to analyse things as they think it's appropriate, because it will be, the answer will be different for different questions.
So you can confirm that in every meeting since the invasion of Ukraine, you have, at the Monetary Policy Committee, explicitly discussed previous
No, we
energy
haven't. We
price
haven't
shocks.
explicitly discussed that far back in history at every meeting. What I said was, where it's useful, we will do that, and we do
Which
that.
meetings have you discussed it at?
Well, I'd have to write to you and give you a list of meetings because I don't have all the staff analysis with me. But where it's appropriate, we will do that. But there are. I mean, I just come back to this point. There was a very big change in inflation regime in this country, really in the first half of the 1990s. And that regime has had a very big impact on not only how policy works, but actually on the economy. So this so-called bias that we have is, I don't see it as a bias. I think what we're saying is, there is a period in which we can see that the behaviour of the economy and the behaviour of policy is sort of done on consistent terms. And we get a lot more value out of looking at that period for what we do today.
Sort of implicit assumptions in the sort of tautological situation you're describing is that inflation expectations do have to be anchored, that the public do have to trust you to get
Yes.
Get inflation back to your target. So I think that the jury's still a bit out on that. But I want to talk about another example of where decision making in organisations can sometimes struggle, and we did get evidence in our July 5th session on what I would put collectively as groupthink. Groupthink internationally, groupthink domestically. Stephen King cited the fact that you don't really have a lot of monetarist expertise on the Monetary Policy Committee. Sushil Wadhwani cited the fact that the decision maker panel evidence, which you've just referred to, was sending out warning signs. And then I also thought it was interesting to read Ben Bernanke's book on the time when he was working with Alan Greenspan when he was leading the US Fed, because he looked at such a wide range of outside indicators, including famously the Tall Buildings Index and I think the Men's Underwear Index. And, there was a lot of qualitative information that was brought into Fed decision making at the time. And then Professor Charlie Bean highlighted the fact that in his experience, the Monetary Policy Committee had space to discuss where we might be wrong and what the nightmare scenarios might be. And I just wondered, under your chairmanship of the committee, Governor, whether you feel you've given enough space to look at those different scenarios that might counteract some of the group.
Well, I'm not in any sense dogmatic about how we approach the question of analysing inflation. Can I just be very clear on that? I really, on this question about groupthink, I think if you look at the voting pattern of the MPC, I don't think you would really conclude that there is groupthink in the MPC at the moment. I think using a broad range of data, yes, is very important. As you know, we often refer to the agents that we have in the country. They get us a lot of data. The decision maker panel that I referred to earlier was created by the bank a few years ago to create a new sort of survey. And we are, frankly, great consumers of evidence and information from all sources. So we're not
Monetarist point of view.
Well, if you look at the latest, the August Monetary Policy Report, I think it's around about page 43 or 44. We have the money growth chart in there. Ben Broadbent made a speech on sort of the role of money back in the summer, I think, and
Summer of 23?
This summer.
Okay.
I'd be happy to send it to you if you would like it. And I think the point I would make is, I think if you look at the sort of the underpinnings of monetary policy, yes, of course, money is important because it is a monetary phenomenon. I would say, as a short-run predictor, money is not as good in that sense. And I also think, I think I'm right, if my memory serves me right, Sushil Wadhwani made a point, and he's right on this, and it's a point Ben Broadbent made in his speech, that of course you can look at it in two ways. You can look at the flow and you can look at the stock, and they will give you different reads, and they will at the moment actually. So the flow read is very weak at the moment. It's actually zero. Actually, M4 growth is zero at the moment. But there is an argument, and I think Susha was alluding to this, I don't think he said it explicitly, but I think he was alluding to this, that you can argue that the stock is larger.
And it sounds as though you've really more recently been looking at this than perhaps you were during the pandemic itself.
Well, I wouldn't say that, because one of the things I said in testimony in the other house a little while ago was that one of the things that I thought was striking during the pandemic period, there are two M4 series. There is M4 and there is M4 lending. And usually there's a fairly good sort of congruence of the two. During the pandemic period, they were going in opposite directions, and we had to interpret what conclusion to draw from that.
We talked about modelling problems, we talked about recency bias, groupthink, and another criticism that came up in that session was around the communication that the Bank of England did, compared in the testimony that we received to the Fed's very clear communication. So the Fed was very clear that it would do what it takes to conquer inflation, whereas the description that we had of the Bank of England's communication style, particularly at the beginning of the inflation period, was that it was much more relaxed. And I just wondered if you had any thoughts about you might make any changes or improvements to your communication.
Well, I think we've always been very clear that we will do what is necessary to return to the inflation target. I don't think we've done that, done anything other than that, really. I mean, I think there's some differences in communication styles across the central banks, depending upon the actual sort of procedure that the central bank uses to reach its decisions. So the European Central Bank, for instance, does not publish votes, whereas we do and the Fed do. I think that makes some difference to the communication procedures. I think it's important that when we're communicating before meetings, that we sort of preserve the space to deliberate in the committee itself. Other central banks are a bit different in that respect. So I do think that it's important that I don't think any of us are going to tell you this afternoon how we're going to vote in 2 weeks' time, because we don't know yet, because we haven't had that process of deliberation. Not all central banks follow that pattern.
Okay. That will be enough from me for the time being. I'm going to bring in Danny. James, do you have something on this?
Just a little question in terms of the groupthink, Governor. I've not got the full voting records in front of me, but for the last year, both you and the Deputy have voted in entirely the same way. Is that entirely coincidental, or is there a particular close lock?
We each make our own decisions. I was talking about the overall voting pattern of the committee. Again, I'd be happy to. I mean, we have the records, so if you'd like me to.
We've got them as well.
Oh,
Thank you. Thank you, James. No, Danny.
Thank you, Chair. I'm going to come on to MPC policy in a moment, but I've got a personnel question for you first, Governor. My constituents, very concerned about the cost of living and inflation, were pretty unimpressed, as I was, to see one of your employees dressing himself up as a zombie and taking part in a protest stunt against government policy not long ago. Do you think that's acceptable behaviour for a Bank of England employee?
Well, I've written to you on the subject. I would be happy to go over any points in the letter. I think what I did in the letter was to set out the bank's policy, to set out the fact that we are reviewing it, because I agree with you on that point, that it has to be reviewed. And one of the questions is, whose time did that occur on, of course, is a relevant question. But I hope I set out the bank's policies clearly in that respect, and they have to be, abided by staff at all times.
Yes, I'm grateful for your letter, and I'm pleased to hear that you're reviewing your policy and indeed the behaviour of this employee, who, of course, is the Labour Party candidate in a by-election. I hope when he returns to his job at the Bank of England after that by-election, as I'm sure he will, somebody will have a word with him.
Can I just say, it is not, of course, our intention to get involved in party politics. That is not.
Of course it's not. No, indeed not.
It is just yours, Danny.
Thank you very much indeed. Well, I think it's important as a public body that they do indeed maintain strict impartiality, and I'm glad to hear the Governor agrees. Mm-hmm. So,
I do.
thank you, Governor. Right. A former chief economist at the bank, Andy Haldane, was quoted this weekend saying that in his view, quantitative easing had gone on for too long, had been too much of it during the COVID crisis, with the result that the unwinding of QE has now had to be too sharp. Do you share that analysis?
Well, Andy said, as I read what he said, and I think he was very careful to say this, that with the benefit of hindsight, or with hindsight, and that is true, of course, he does have hindsight. As Andy knows well, because he's a former member of the MPC, we don't have hindsight at the point when we make policy decisions. And we've had this question, I think, quite a few hearings in the committee. So whatever you think about the hindsight decision, and I don't enter into those judgments because I think it is very difficult then to separate out the hindsight judgment from the decision at the time. I would say, going back to that point in time, and I think Andy was referring to the sort of the last phase of QE that we did, not the QE that we did in 2020, when I think he made the point that stabilising the economy was, of critical importance at that point. And we did it on what we tend to call risk management grounds, which was, it was not a big flow of QE at that point. It was quite a small flow of QE, relatively speaking, to what we'd done in 2020. But our concern was that with a lot of uncertainty still around the situation with COVID, it provided a degree of insurance against volatility and a rise, particularly at the sort of medium end of the medium part of the yield curve, which had been a problem in 2020. And I think a number of people, I think Charlie Bean may have said this at one of the hearings, was that I think most of the people who give evidence on this say they don't think actually it made a major contribution to inflation, but it was done with risk management grounds.
Okay. Understood. Thank you. In terms of the QT, however, we're now you're selling bonds back at a loss, which of course the taxpayer carries. Are you content that the rate of selling is appropriate, that the price you're getting is right, fair from a taxpayer's point of view, or are you not regarding that as part of your
can I
remit?
Draw a distinction between what I call the cash flow and of course the overall cost benefits of all of this, which is a much bigger calculation and has to take into effect the economic effects of this throughout its life and the situations we've had to deal with. Our objective is to reduce the balance sheet over a period of time. We do not want to cause what I call market disturbances doing it. I don't think we've done that so far. We're about to come up to a decision at the next meeting for what we're going to do for the year ahead, which we will consider at the meeting round to come. At the moment, I don't consider that it is, say, causing market disturbance. The cash flow, of course, in the end, we'll see what it is, because it will take a long time to happen, and that will depend upon where the yield curve is throughout this period. I mean, what the level of interest rates is really throughout this period.
We are talking about selling at a loss, which is the taxpayer.
At the moment, there's a negative.
Has to pick that up.
Can I just say there is a negative cash flow at the moment. Of course, there was a positive cash flow for a long time from QE, which didn't get commented on at the time.
Okay, all right. The other thing that Andy Haldane said is he fears that we're on the edge of recession. So I'd be interested in your view, or perhaps colleagues' views, on the likelihood of a recession. And of course, it would be pretty catastrophic to be both in a recession and with inflation at high levels. You'd expect inflation to be low in a recession. I mean, you talked earlier, Governor, about your expectation of a quite marked reduction in inflation in the second half of this year. Of course, you were predicting that earlier in the year too. So what do you think, by all means, other colleagues might want to answer this? How close to a recession do you think we are?
Well, can I make 2 points at the end? I'll shut up then, because I've said a lot and let others come in. I think at the last hearing we had on monetary policy, I think there were some questions about where we were relative to the forecast. I would say relative to the May forecast, we are within 0.1 at the moment on inflation of where we were.
You're just over 1% higher than you were at the May 20, the one right after the invasion of Ukraine.
Yes.
So the outturn now
Yes,
is 1% higher than you.
I'm talking about May this year.
Yeah.
When I think you asked me that question previously. I think actually in the May forecast, the July figure would have been 6.9. It was actually 6.8. So we are, we haven't had the degree of shocks in the last year that we obviously had when following the invasion of Ukraine. So in that sense, I think inflation is coming down, and our sort of short-term forecast is performing better. I think it is, I should say, possibly that we will get a tick up in the next release, because fuel prices went down in August last year and went up a bit in August this year. But I don't see that as essentially changing the path. of inflation. It's in our forecast, actually. On the recession question, I mean, the August Monetary Policy Report does not have a recession in it, but of course it has, I'll be the first to say, it has a very weak growth path in it. So, growth, it is just above zero throughout.
Yes, indeed.
So it is a weak path of growth.
And yet you just raised rates again. But perhaps I'll invite Dr. Dhingra to comment on this. You've been voting for no change in the bank rate since it was at 3%, but you voted again for no change this time. Why didn't you vote for a cut? As the Governor says, we are seeing very low growth at the moment.
I think my decision's based on demand in general and activity being weak, which is that we don't need to tighten to the extent that we would have otherwise done. In terms of why haven't I voted for cuts as opposed to sort of going along with the committee, I think what hasn't really been appreciated enough in the media and financial markets is the duration of how long we keep our policy in tighter territory. And I think that trade-off between how high you go and what the duration of staying high is really fundamental here. And my preferred policy, of course, which now is not something that will happen, it would have been a more moderate rate so that you don't see a mountain shape. You instead see something which is much smoother, so that there's a much more balanced transmission, because if you're somebody who's coming up for renegotiation right now with your lenders, naturally you're exposed to much higher rates than you would have been had it been a more moderate path. But that would also imply that the duration would possibly have to have been longer.
I see.
So,
okay. So are you content with the gift of hindsight that you were right to, or rather that the committee was right with the rate rises that we've seen in recent months, or do you think that you were right to have proposed a hold?
I think I would put it that it's certainly somewhere in the middle. The one positive news that came, which was relative between December and February, was that energy prices, the increase in them unwound much faster than most of us thought. We were still at that point thinking about energy shortages, which could have had a really big impact on the economy. So fortunately, that didn't happen. And I think that's the reason that we saw some pickup in activity, which would then justify that, yes, maybe somewhere in the range of where the February vote was that I went with would have been appropriate from my point of view.
Okay, great. One last question?
Yes, of course.
Very quickly, thank you. I mean, you mentioned the duration of high rates, but as I understand it, the market expectation of the bank rate is now to be higher, 6% next year. I appreciate you don't want to make predictions at this stage, you're waiting for your next meeting, but I would just be interested in views from the panel. Perhaps Sir John might want to come in first on that prediction of 6% going into the end of 24.
So if I might just wind the clock back
Sure.
a bit and talk about what we've learned over the past year. So over the past year, we've learned the economy was more resilient to the cost of living shock, if I can put it that way, than had been anticipated. Some of that is the downside surprise in energy prices. Some of that's government support, but some of that you may find is just the level of activity in the economy has been higher than we thought. And I think those ONS revisions, which only go back to 2021, they're going to roll them forward, but if the growth rates are the same, then we would expect just the level of GDP to be higher than the official data was saying. We were reflecting that, I think, in February and May, and I can say a bit about forecasting models if you'd like, Chair, but we were reflecting that with judgments of higher activity, more resilience in the economy. And the risk, I think, and this goes back to your point about non-linearities, and I mean, we were talking about those in the committee, certainly for November, when Hugh Pill referred November 2022. We were talking about multiplicative effects, that actually the combination of a very tight labour market held up by strong activity and then very strong externally generated price pressures could lead to catch-up and second-round effects that would drive inflation high. And for me, what we learned over the first half of this year was that risk, and I think that risk was reflected in where the committee as a whole set policy, that risk was starting to crystallise. So we had a very big upside surprise in pay between the May forecast and the June meeting. We had an upside surprise in service price inflation.
You just, again, say which year?
Upside June of this year.
Yeah.
So June of this year we raised rates by 0.5%. There was a split vote on the committee, but the vote was to raise by 0.5%. And that was in the light of a 0.5% upside surprise on private sector pay and a surprise on service price inflation. And these are things which the committee has said indicate persistence, and this is where we come into the following next year and the forecast going forward. And I think that led the committee as a whole to the view that we would need rates at a higher level going forward to contain that risk which had crystallised. We had a similar vote, but not to the same degree, in August. The committee said it would look at the labour market, wages, service prices as key indicators of persistence of how long these inflationary, domestically generated inflation pressures are going to go. So I think, for me, the vote in September, and I can't tell you how I'm going to vote, and we have more data to come, but will depend in part on that. And we're getting mixed signals now. We're still getting strong pay growth and service price inflation, but we're also starting to see some cooling in the labour market. And that will be the kind of discussion going forward.
Just lastly,
I'm going to bring John in.
Okay,
John in now,
fine.
I think. Yeah.
Can I, as you know, Governor, some of us on this committee have been quite critical of the government's interest rate policy in the past, and before one's accused of the benefit of hindsight, some of us are writing about this at the time, as I think you know. I mean, I put it to you that what we have at the moment is a situation that because the Bank of England was so far behind the curve on inflation, we've had the most aggressive tightening cycle since the bank's independence in '97. And you're in the process of playing catch-up now, and interest rates may be a bit higher than they would otherwise have been had you been more proactive earlier in the curve when there were clear signs of inflation. And this is hurting people. This is attributing at a time when there is a cost of living crisis. It really is. It's impacting. What I would ask you now is, having got to this peak after a very aggressive rise, it doesn't allow you the time to pause to see what effect your interest rate rises are having. And I suggest to you that the follow-on from that earlier conversation with Danny, Mr. Kruger, is that you risk over-tightening, and because what you need to do is pause, given the time lag with regards to interest rates, their effect in the economy. Typically, certainly 3 months, sometimes 6, sometimes 9 months, and we're seeing that with fixed-rate mortgages. What would you say to that charge?
Well, I'd pick up on something John said. I'm not, first of all, what I'm about to say is not a comment on what we're going to do at the next meeting. That is obviously very much to be decided. So this is a more general comment. I think we've moved from a period where, and I think we've discussed this before, I would disagree with you on this catch-up point because of the nature of the shocks that we've had, and particularly the shocks we had last year coming from the Ukrainian war. So there was a period where it seemed to me it was clear that rates needed to rise going forwards, and the question for us was how much and over what time frame. But we're not, I think, in that pace anymore, and that's why we shifted our language to being much more evidence and data driven to start with. That was important. We also introduced in August, very deliberately, the point that we think policy is now restrictive in its impact. And I say that because I think the judgments now are much finer, because I think, I understand your point, as it were. I think we are much nearer now to the top of the cycle, and I'm not therefore saying we're at the top of the cycle because we've got a meeting to come, but I think we are much nearer to it on interest rates on the basis of current evidence. Now, just to finish, going back to Swati's point, it's interesting that, by the way, the 6% today is 5.8. The market's come off a bit, so it's 5.75 today. The difference between holding it flat for 3 years, which is our sort of forecast period, and the market curve, the average interest rate difference is about 0.25%. So it's not a very large number, and that's because one of them goes up and comes down, and the other one stays flat. But the average, so the up-down is about 0.25% higher on average than the flat. And I think one of the questions that we obviously do consider, and we'll have to go on considering that carefully, is there anything more beyond that 0.25% average difference in putting them up and bringing them down again, or is, as Swati said, is the holding constant path once we feel we're at the right level? Because I just again make this point, I'm not making a comment on the next meeting. The right thing to do, and that will be an important judgment we have to make. So I take you make a point that actually is very much in our thinking as well.
Okay. Can I just broaden this out a little bit, moving on from the current, where the interest rates are at the moment, and just looking back a bit about lessons learned. I know Ben Benaki's coming in, you're having a fundamental review of your modelling process. But I just want to know how meaningful this is going to be, or get an indication from you. I mean, the Chair quite rightly raised the issue of recency bias. I mean, any look at 100 years of inflation would have told you that, a spike into double figures would take at least 2 years to return to pre-spike levels. It's a lesson that is there in history, because inflation gets embedded, the point that was raised earlier, but doesn't seem to have been taken on by the MPC. So history is important, but I'd also suggest to you money supply is important. It's not a direct relationship, of course, but it's a bit of a coincidence that we had a massive spike in money supply in the beginning of the decade, and within a pretty fast time afterwards, we had a spike in inflation. How broad range is this and meaningful is this review going to be, or are we just going to see, in the nicest possible way, just a little bit more? And I hope you don't take this personally, because I think it's a criticism of central banks generally of groupthink.
Well, first of all, there is no constraints from us on the work that Ben Bernanke is going to do. I can assure you of that. We are, I think, I'm very, very pleased that he agreed to do it. He's, I think, eminently well qualified to do it. And of course we won't constrain it, and I can't imagine he would have accepted if we had done anyway, so there's no question of that. So, it will go where it goes to, as it were, and he's very much in control of that, and that's as we want it. So no constraint from this point of view of the approach of the committee or the bank executive. We are, very eager to do this, because I do think it's, of course it's important that we learn from this. I mean, this has been some huge shocks to the economy, and we can learn a lot from this. So I can assure you there is no constraints. And I mean, let me say, of course, I wouldn't presume as to what you want to do. I have said to him, because I wanted to make it clear before he accepted, that you may well want to speak to him. It's obviously up to you whether you do. But I wanted him to be, eyes open. Now, he's done Congress a lot, so it wasn't at all an issue for him. But obviously, that offer is there if you wish to take it up.
Finally, can I just, on the appointment itself, I mean, Ben Bernanke doesn't come without a little bit of concern in some quarters. I mean, let's be clear about this. I mean, no one can question the economic CV, but, he was chair of the Fed and didn't see any financial crisis coming along, neither did his team. He invented the concept of quantitative easing. And I think there is strong evidence to suggest that certainly the second round of quantitative easing has partially, at least, resulted in an inflationary spike. I mean, I know you were party to this decision, but I would just put to you that the concern from some of us have is that it's not challenging, the appointment would not challenge the groupthink mentality that I think bedevils not just the Bank of England, but central banks generally.
I mean, if you look at Ben Bernanke's career, he is a very eminent monetary economist.
One's not questioning the economic...
I mean, he really is.
Yeah, but can I just say, one's not questioning the economic CV. You cannot fault it. One is questioning is the fact that, from an economist's point of view, he's ticked all the boxes. But the trouble is, and we've raised this as a committee beforehand with you, is that our concern is that there is too much groupthink amongst economists generally, which is why central banks, not just the Bank of England, although I think the Bank of England has been a bit too far behind the curve for the reasons we've previously discussed, but there is this groupthink mentality and not enough people questioning the norm, not enough black box thinking.
Well, look, I think I would reiterate, the offer is there. If you wish to ask him that question when the moment comes, I'm sure he will be happy to answer it. And I think that's the best thing I can say on that. I don't think it's right for me to speak for Ben Bernanke. I think he can speak for himself on that point.
Okay, thank you.
Thank you, John. Andrea. Thanks. I'd like to talk a bit more about the risk of over-tightening. And Sir John, I'd like to ask you, first of all, if I may. The UK Purchasing Managers Index fell into negative territory in its lowest level in 31 months in its last session. And your own agents on the MPC are warning about weaker sales volumes, falling revenue growth, and interest rates and uncertainty weighing on investment plans. All quotes from the from the PMI and your own agents. Do you see this as a necessary slowdown to stop inflation, or do you see this as a risk of over-tightening?
The first thing I'd say is the evidence is mixed, and we are getting mixed signals about the economy now, which is what you expect when you come into periods where you might be close to turning points and the like. And I just reiterate what the Governor said about finely balanced. So yes, the SIPS output index shows that. Curiously enough, the expectations index is very positive from the same survey. So we have a survey that is very negative about output now and very positive about output in 3 to 6 months' time. But also, we don't just use one survey, and this goes back to some of the Chair's questions about a range of data. The other surveys we tend to look with don't have that read. So at the moment, the bank's view, and it's very similar to what was in the August NPR, hasn't changed much, is that underlying growth is around, quarterly growth is around 0.25%. It may be the SIP survey is signalling actually that the economy is going to grow at a slower rate than that. But as I say, there are other data that suggest not. And of course, the pay data lag the activity data. It takes time for all that to work through. But certainly, the labour market is cooling a little bit. Unemployment's up to 4.2 from 4 in the August report. But we're still seeing, in my view anyway, quite a slow cooling of the labour market, and those, I call them multiplicative, but those pressures on pay, those non-linearities, which we saw as a risk and now we think have crystallised, are coming through. So I think that the challenge for the committee over the next few months, and I should say here my last meeting that I'll be involved in monetary policy is September, because my term ends at the end of October, so I won't be able to vote in November. But the challenge for the committee will be to read those two things, to see whether we're going to get persistent inflation, because we need to bring inflation back to target, or whether we're getting enough cooling in the economy. If the question is cooling in the economy and the labour market necessary relative to where it would otherwise be to bring inflation down, yes, I mean that's how monetary policy operates.
You sound to me, correct me if I'm wrong, as though you think the balance is still on the side of raising rates because the inflation is still persistent.
I'll look at the next set of data and make my decision, but certainly I voted, and to answer the question, I vote on my own basis. I have voted against the majority in the past. I look at the data and reach a view. That's why we have 9 members on the committee. So there is no kind of, I am not constrained by the Governor in any way in which I vote. I voted for an increase in August and a larger increase in June because I was worried about those persistence pressures and the interaction of stronger demand than we had seen with catch up and people looking back to try and recover lost prices, lost wages from the inflationary period. I'll look at the data, but we are clearly getting to a point where headline inflation is going down. So the Governor said that will feed into people's decisions, and where we are starting to see some movement in the labour market and cooling. We haven't yet seen that in pay, but it will come down. Can I just make one point about forecasting?
If you would, thanks.
Yeah, so and modelling. So I just because it's important to very important to this point. So we start with the model, you know, and all models are caricatures of real life. So one knows that, and a suite of models, and that's the starting point. But then the MPC itself puts judgments that change the model, and we made some quite big judgments in the past about inflation persistence and the like. And then finally, when we have a committee, the best collective view of the committee, which is our judgment on top of the model keeps us honest, so it ensures there's a kind of general equilibrium. We can't just move things around.
Thank you.
But then when we've done that,
Thank you.
we then deal with risk.
I know how modelling and forecasting works. Is there
I think the key thing is not what is in the model or the suite of models.
Yeah.
The key thing is when you're going through periods which have movements in inflation that we haven't seen before, not even in the 70s actually, okay, to what extent, how does the committee apply judgment and deal with risk on top of those. So I very much hope Dr. Bernanke is going to look in specifically at those areas.
Thank you. Thank you very much. Ms. Stheeman, can I ask you, as the member of the FPC, if you have any concerns about financial stability with regards to the activities of the MPC and the risk of over-tightening leading to financial stability, such as we saw with the Silicon Valley Bank, for example?
Thank you for the question. On the FPC, obviously, we look across a very broad range of topics. In terms of what the FPC would be focused on is seeing that bringing inflation back to target would be consistent with, especially if it's done sustainably, being consistent with bringing interest rates back to a sustainable level. So in some ways it could be even worse if one wouldn't do anything about it. So that's why, as you've heard from MPC colleagues here, it's a very finely balanced decision. As you know, we as a committee, as the FPC, don't get involved in interest rates decisions. Having said that, what we'll obviously look at, to what extent there might be any financial stability implications.
And would you be concerned about the speed of interest rate rises creating financial instability? Is that something that you've discussed on the FPC?
What we would look at is a range of different issues. So if you look, for example, at the last ACS, the annual cyclical scenario, the stress testing, the FPC would look not just at the path of interest rate, but also in particular at the development of unemployment. As Sir John already said, unemployment has been much lower than, for example, the stress test. So the stress test scenario include an unemployment level at peak of 8.5%, whereas current employment is just under half of that at 4.2%. And then the stress test would also look at other things such as GDP rises. And what is important from the FPC's perspective is that the UK banking and broader financial sector is resilient to any shocks. And the last ACS or stress test has shown that the UK banking sector would be resilient. And
you're not biting your nails and lying awake at night wondering about the next MPC decision.
Thankfully, not. I've got other things to worry about at night.
Thank you. And Dr. Dhingra, you, in the latest MPC minutes, you warn, and quoting from your comments, lags in the effects of monetary policy meant that sizable impacts from past and recent rate increases were still to come through, while recent news in components of consumer and producer price inflation strongly indicated a downward trajectory for CPI inflation. So do the latest survey results confirm your view?
Yes, and this is in fact getting back very directly to the question that the chair raised about recency bias. So I've looked at a range of producer price inflation indices as well as consumer price. And it turns out that even through the 1970s and the really high inflation episodes, these two things have moved very tightly together. There's usually a lag between when PPI moves and when CPI turns. CPI tends to lag the turning point in producer price inflation. And even looking at the very, very item level detail, you can see that almost every item in the basket has turned at this point. And as we know, producer price inflation has fallen much more once you correct for the fact that the items that we produce are not really the items that we consume, and you correct for that composition, you see that the tight historical relationship is still maintained. And my hope would be that's a very, very promising sign that, in fact, we are going to see a downward trajectory for consumer price inflation.
Thank you. So the monetary policy report highlights that firms have taken out annual and fixed-term contracts for supplies of food and energy, which therefore, of course, has the effect of delaying the pass-through of wholesale prices falls. So since monetary policy can't do anything about that, is that another source of the risk of over-tightening?
That certainly would be, and this is one of the places where we're in some level of darkness because we don't really know what precisely those lags are. So again, going back to the historical data, the 1970s and 1980s are not particularly informative in that respect because we didn't have the kind of global supply chains that we have at the moment. And that has really clouded our judgment in terms of when we think the turning points should be and how long that should take. That being said, I think one thing, and this is one of the reasons where I differ from the majority of the committee, that I don't find services price inflation and some of these other measures particularly informative because they have a huge amount of imported and energy content to them. And if you do think of the supply chain, the point at which they get that inflation coming through to them from, say, the border to finally coming to them, that lag would be much longer for services producers, and therefore I would actually expect that to be a more late cycle indicator than consumer prices or other measures of inflation.
So it sounds as though you would still be feeling that we need to wait and see the effect of recent increases.
Yes, this is a very sharp tightening in a very short span of time.
Absolutely. So, Governor, just to finish with you, would you comment on that? Do you have some sympathy with that view that there's a lot still to be seen from the very sharp rises in interest rates, and there is a risk of over tightening?
Well, we've definitely got a substantial amount of transmission to come. Now, of course, what you have to factor in then is to what extent people anticipate that. So they anticipate, for instance, that their mortgage payments are going to rise. I mean, that's a question in and of itself. And again, one of the questions on the recency bias is that, for instance, the mortgage market has changed fundamentally. So we wouldn't learn a lot by going a long way back in time on that point. Well, I think Swati makes a very interesting point. The pass-through from producer prices to consumer prices on goods price inflation has been slower. But Swati's right, that it's very dramatic on producer prices. We've got negative producer price inflation now, if I remember rightly, in this country. So the question for us is how long is that pass-through going to take? And of course it comes back to earlier questions that the chair and others were asking about. If we have this longer delay, how much is that going to cause more persistent inflation, and that affect people's expectations as well. And we have to consider that every time. I would lean somewhat more against that than Swati would, but we're on the same page in terms of what are the issues here that we're trying to come to terms with.
So you do accept that there is a risk of over tightening here?
Well, what I would say is it appears that there is a longer transmission, that the lags are longer. And this is this asymmetry point that John was referring to earlier, and we have to factor that in our policy decision. Now, if you look at the inflation profile in the monetary policy report, it comes back to target. On the modal case, it may go a bit below target, and we're having to judge the risk around that all the time.
I realise that, but I'm asking you if there is a risk, and it sounds to me as though you're accepting there is a risk of over tightening.
Well, there's a distribution of possible outcomes around any central path. The central path returns us to target.
Thank you.
Maureen. Thank you, Chair. We now turn to the impact of the monetary policy, the tightening policy, on investment and trade for businesses, a bit further down the food chain, if I can put it like that. So, Don, can I ask you, in terms of investment, what are you seeing in terms of the impact on investment in the way that businesses are now making decisions? So are we seeing high cost of borrowing? Are we seeing lower availability of lending? Are we seeing lower profit, lower demand? And taking all that in the round, how is that impacting the timing of businesses deciding whether or not to invest and ultimately growth?
So we're seeing some tightening of credit conditions, which is what you would expect. So the question of the supply, but in a way that is what you would expect when interest rates are up and growth is low. So banks and other lenders are taking risk-based decisions. I don't think we're seeing anything like a credit crunch at the moment, if we come on to that. At the same time, we're seeing, I think, businesses slowing investment decisions because interest rates are higher. So the hurdle rate for investment is higher. And going into this period, one of the channels through which monetary policy works is it slows investment and it slows business activity. And I come back to this question of cooling in the economy. That, to some extent, is what you would expect. we're seeing in terms of indebtedness, which is a slightly different, that in terms of net debt to income in aggregate, UK corporates are very strong. And if we look at interest rate cover, so that is the ratio of revenue to debt service, we're seeing a rise in more indebted companies, which again is what you would expect to see when interest rates go up because debt service is going up, but nowhere near to the levels that we've seen in past peaks. Where there may be a more acute problem, and the FSR recognises this, I think the July FSR, is smaller businesses. We have less information on them because they don't have to file the same detailed accounts as we do for larger companies. But there we are seeing some evidence, and we're getting some of this from the agents as well, that within the SME sector there is demand for lending is going up a little bit, and supply of lending may be constricted a little bit. If I look at it from the macro top down, the bank's forecast, I think our forecast for investment over the next 2 years is very low. So my recollection is investment was running at something like 3.75% a year up to in the pre-COVID period, and I think we have we've seen lower investment in the UK since the middle of the last decade, and the forecast going forward, I'd have to refresh my memory, but I think it's investment growth of 0.2, 0.3% next year and the year after. So we're forecasting that actually business investment will be one of the channels through which monetary policy works.
Is there a risk then that we damage business confidence such that growth is not just temporarily damped, but there is a long-term, if you like, hit to the economy in terms of the growth we might otherwise have seen?
I'd say it's important to step back a little bit and say if we wind up with persistent inflation, persistently above the target in this country, that will damage business confidence an awful lot more. One of the reasons why I think the control of inflation, going back to your point, Chair, is so important is not just because of the tax it imposes, but it distorts price signals in the economy. It makes investment decisions much, much more difficult, and it increases macroeconomic volatility if you wind up with persistent inflation. So I think if I was thinking about business confidence going forward, then I think business confidence is served best by macroeconomic stability and a sense of confidence in the monetary and the fiscal regime, because those are the two frameworks actually that allow businesses to invest with confidence about the future. I do think business, looking at, we'll go back to that SIP survey, I mean business seems to be a bit more confident going forward than it is at the moment, just on that one survey. But the worst thing I think to do for business confidence would be not to let monetary policy operate to bring inflation back to target.
Thank you. Ms. Stheeman, can I ask you now, in terms of debt, we talked a little bit about this with Dame Andrea, financial instability. The debt servicing costs are going up, and insolvency rates are going up. Given the comments made about the different levels, we've got, your FTSEs, but then you've got your SMEs and then the micros. What sort of a risk to financial instability is this increase in insolvency and increase in debt servicing costs? Which piece, if you like, of the hierarchy is going to be most impacted, and how damaging is that going to be on our economy, particularly when we have to then move to the upturn, hopefully, in the future?
Yeah, I think you make a really important point, because obviously that's something the Financial Policy Committee is very focused on. Just adding to what Sir John said is on the SME front, while we don't have as much information as we'd like. What we found out following the pandemic or during the pandemic, that a lot of SMEs actually hadn't borrowed before and then accessed the government schemes. And that the one number we do know is that about 70% of SME debt is floating. So that obviously means, coming back to what Dr. Dhingra said about pass-through, is that once that flow, comes through, that they could potentially be more impacted. That is less the case in larger corporates. Firstly, they have broader access to debt. I mean, one of the things as an external FPC member I do is I'm spending time in the regions. I was in Bradford and Leeds and Yorkshire earlier this year, and then I was in the Northwest earlier this summer. And what came through very clearly is that there is a big focus on continuing asset access to lending. And one of the organizations I spoke to, together with the regional agents who set it up, is one of the lenders who particularly focus on SME lending. Now, I don't know whether you were interested in households as well, or is it just corporates you wanted to talk about?
Tell me about households.
Okay, well, households, obviously, in terms of the DSR or debt servicing ratio, is something the FPC has looked at very, very closely. What gives us some reassurance, they're comparing this back to the 1990 crisis, and then more importantly also the global financial crisis, is that far more mortgages these days are fixed rate.
I think we will have more questions on households
Okay,
later on.
just wanted to make sure I cover what you wanted to hear. That's fine.
When you say you don't have very much information, or not as much as you would like, on SMEs, how are you going to, going forward, fill that gap given the risk? Because by volume, they represent quite a large chunk of the economy.
Yeah, that's something, and I'll let others come in. That's something certainly as a committee we've asked staff to look into. And there again, the regional network is incredibly important, because regional agents will have access to companies directly. And what they do, for example, at every pre-briefing before the FPC round starts, they will report back. And if we have a specific question, we can, for example, go to staff and to the regional agents and say, okay, can you find out more? But given that they don't have as much information to larger companies' house, it's harder.
I would just add that we do our own credit conditions survey every quarter. We also have access through our supervisors in the PRA to all the banks' lending book information, so we can put that to work as well.
Thank you. Then finally, on currency. Now, strengthening the currency helps, but given where we were, is it that much of a help? And what has been the impact on imports and exports? Maybe Mr. Bailey, you'd like to take that one.
Well, we don't target the exchange rate, if you don't. I mean, let me be very clear on that, because that's not our objective. So you're right, of course, that a movement in the currency will have an effect. But of course, all movements in exchange rates are relative movements relative to other regimes, as it were. Nearly all central banks are tightening monetary policy at the moment in not dissimilar degrees. So the exchange rate has strengthened over the last 12 months. That's certainly the case. But so we don't target it. We take it into account, obviously, because it's an important part of the transmission mechanism of monetary policy.
Okay, so you take it into account, but you don't monitor what its impact is, which is different.
Well,
May I add something to that? So just because I've worked on exchange rates in the past in particular. So typically you would expect, and this is the old estimate, that 1 percentage point increase in sterling would translate into a 0.1% decrease, say, in the consumer price. Broadly, we're roughly in the ballpark as well right now. So if you think of what happened in terms of sort of this year, 6% increase in sterling. If you look at what the fraction of the import basket is in consumption, and you look at how much is priced in dollars, euros, everything else, and therefore how much the currency matters, you would come up with a number somewhere in the range of 1 percentage point or less. So it has had an impact on CPI, but it isn't big enough that you would think that that's going to change from where we were to something very dramatic.
Thank you.
Thank you, Anne-Marie. James.
Thank you, Harriet. Governor, before I come to you and talk about savings, I'm conscious, Sir John, I'm more familiar with your work in Brussels and the Cabinet Office, but you've a vast amount of experience, and this is probably the last time you're before the committee. What would be your reflections and advice to future committees, and indeed ourselves?
Well, so first of all, I think, and I've been involved with the MPC since its launch in 1997 and was involved in the legislation that launched it. I think the system we have of a 9-member committee, and the Governor was saying something about this, and voting and transparency, I think actually has served the country well. And in terms of the monetary framework, I think the MPC will always need to kind of deal with new challenges. But I think in terms of the monetary framework, it's and one can think about reviews of the mandate, or reviews of the remit, and the like. But the underlying framework, I think, is a solid one.
And the one, just to challenge you and push you a little bit more, the one thing you might change, or the one thing that both the committee and those that govern it should look at?
I think well, first of all, I think the committee and the way it proceeds always needs to think about change, and always needs to think about, can it do things in a different way. I talked a little bit about the Bernanke review. I think the way in which and different central banks do forecasting and take forecasting into policy, which is the important thing, in very different ways. So we published a committee forecast. The ECB does not. The Fed has a different model, and it's this point. The thing that the world of central banking has not been as ordered and sedate as I hoped when I joined the committee in 2014. We've had some really big shocks over my period in the committee, and it may be that the world economy is becoming just more volatile. Geopolitics come into this and subject to bigger shocks. Mm-hmm. So how you navigate through periods where, the 70s is relevant, but as I say, we've seen shocks of a sort, or a pandemic, which we haven't seen a global pandemic since the 1920s. How you navigate through periods of extreme macro change and pressure, I think, is a real challenge for central banks going forward.
Thank you, and good luck going forward. I'm sure you'll be close to things as you have in the past. Governor, can I take you on to the savings rate, which is of particular interest for constituents?
Yes.
The August MPC report noted as base moods 3.75. The interest rate on the average account was only 1.8%. Clearly there is going to be some margin there for the banks, but this seems excessive. What is the right margin, and why aren't those rates being passed on?
Interesting question, thank you. So we have in recent months and seen, over the last couple of months, seen quite a pickup in the pass-through to sight deposits. Pass-through to term deposits was been faster throughout, actually. That's the sort of 6-month, 1-year deposits. But we have seen a pickup in the pass-through to sight deposits in the last couple of months or so. We've just seen the most recent monthly numbers. Now, I hope that means that we are sort of into a more, into a sort of a new phase, as it were. We can. I'm happy to sort of speculate a little bit about why that might have been. I think if you go to the sort of more fundamentals, I think the story I would say is when pre-financial crisis, there was a fairly settled relationship between deposit rates and our official rate. They were somewhat below our official rate. When the financial crisis happened and the bank cut interest rates nearly to zero, what happened was that the banks did not reduce their deposit rates to nearly zero, so they sat above our rate for obviously for the last decade, really, or more now, 15 years now. We've actually seen that revert now to its previous relationship as we've obviously got rates now back up into their sort of more normal environment. And I think we've obviously been through a period where that reversion was happening. And you were right, this committee was right to highlight what was going on at that point. I'm more reassured by the fact that, I say, of late, in the last very recent numbers, we're now seeing more full pass-through, because clearly what you can't see is that discrepancy just going on forever, because then the net interest margin is widening forever. So I hope that what we've seen is a bit of a structural adjustment, with some encouragement, I'll say, from sides. But we've seen a structural adjustment, which will now put us into a different phase where the pass-through is more,
concerned about customer intransigence, so the terms rates, those are people taking active decisions. I'm almost more worried about the constituents that don't come to see me to complain about this, the ones that are just sitting on really low rates. In previous evidence, Barclays seemed to be a particular bad offender, the company I used to work for, so slightly regret that being the position. Of the big four, Lloyds Bank were offering 1.4%. Santander described it on my notes as a challenger bank. I'm not sure that's how I would describe them. Still pretty pathetic at the highest 2.5. Do we think that is acceptable? And what are the impacts of that? Not just for consumers, but let's face it, why bother saving at those negative interest rates?
Santander brought in quite a good instant access rate, that, according to
I've got 2.5, which I don't think is particularly good. Maybe they've got a better rate coming up.
I think I'd stress two things.
Last, yes.
I'd stress, obviously, competition is important and transparency is important. Now, that's of course much more in the domain of the FCA. The FCA is doing things. I know you have regular hearings with the FCA, so I'll leave that for those. But I think it is important that we have transparency for the reason you give, which is that we may sort of think that the aggregate position is looking better, but the distribution could be quite skewed, and there will always be people who are just not aware through the normal channels, who don't look at the normal channels or don't respond to them, and the question of better transparency is important. I agree with you.
Presumably there's the other side as well of people that are taking decisions about what to do with their money, so they've got an extra bit of cash in their pocket, and instead of putting it into a savings account, which will then free up liquidity for investment, they're doing something else with that money, either something much more risky or much more passive in terms of just spending it. Do you have a view of the impact of that margin being wide on broader behaviours within the macroeconomic situation?
Well, of course, what they do with it won't necessarily affect the stock of money, so it would in a sense get deposited by somebody else somewhere else, potentially. So it's in general equilibrium, it's not quite so straightforward as that, so there will always be an effect. Different people will always take different choices, and of course actually we also want obviously a degree of, it goes back to the point John was talking about in terms of investment. We also want risk-taking and investment, and part of that will come through the banking system and part of it will come through the non-banking system, and it's important. It's important that we get that, because if we go back to the questions that we had earlier on on what I might call the trend rate of growth and how we raise the trend rate of growth in the economy, then of course investment and productivity growth is important.
Mention the subject slightly in the final few minutes. Wales, clearly people that are banked shouldn't have their bank accounts closed for political reasons, political parties, political individuals. We're also doing a report on sexism in the city. In that regard, it was very upsetting to see Alison Rose go, given she was a power finder. What are your broad reflections on both those bank closures, but also supporting everybody through careers in the city? Certainly when I was in the city, it was 80% male dominated. It's much better now, but what are the lessons to support further?
That's important. Well, first of all, let me say, and I'm obviously, again, I make this point very deliberately, but I don't take sides. It is unacceptable to close bank accounts on the basis of people's politics. Absolutely unacceptable. And I say that both ways. I'm not making a point either way. That can't happen. On the question of diversity, I agree with you. Both of the regulator, the FCA and the PRA, are going to come out fairly soon now with a piece of work on diversity and inclusion. I very much agree with you on this. And what I would say is, because I'm not sure this is always the sense you get in some of the reporting, it's a personal view, I think that greater diversity will actually lead to better decisions being taken on things like, bank account maintenance. I think, we really need to support this as a means to, and I'm not, when I say that, I really have no time for getting into the woke debate, whatever woke means. I don't really know what it means actually as a word, but this is not about that. It's really not about that. It's about having good decision making made by institutions that are broadly representative of the country that we serve.
Thank you.
Vaughan.
Thank you very much. I'd like to look at mortgages, renters and the housing market. We've made a couple of references to them. August's monetary policy tells us that we won't understand full impact of higher mortgage rates for some time because of the prevalence of fixed rate mortgages and the delaying impact that has on policy transmission. Your figures suggest that at around 4 million households currently locked into fixed rate mortgages will face increased costs before the end of 2026. I have a constituent who is trying to renegotiate his mortgage, and he's been told that if he wants to have a package for 2 years, the increase per month will be £400. If it's 5 years, it'll be £350, and if it's 10 years, it'll be £300 per month. Now, from my reading of that suggests that high interest mortgage interest rates are with us for some time to come.
Well, the banks have to price fixed rate mortgages off the interest rate curve today when they're making mortgages, giving mortgages. So your comment about high mortgage rates will be here for a long time to come, of course, that is based on where the interest rate curve is today. The interest rate curve in a year's time may not be, it won't be, it'll be somewhere else, but we don't know where. But they have to price them because they have to go into the interest rate swap market and swap it, whatever it is, 2, 5, or whatever years. So they are pricing off the curve, and that's the way a fixed rate mortgage market works. It is obviously different from a variable rate mortgage market because, although some of their deposit base is at fixed term, most of it isn't actually. So they have to hedge that. They have to hedge that position to hedge their own risk, their own interest rate risk.
So how long will people be offered packages that are beyond most people's ability to pay because they just don't have that gap in their budgets?
Well, I think it comes back to the discussion we've been having about monetary policy. I mean, what I would expect to happen is that as inflation returns to target, that will be reflected further out in the curve, but we don't know by how much, I'm afraid, at the moment.
If we look at private renting, and I quote from June's Monetary Policy Committee, the committee also recognised that it had become more important to consider developments in the rental market. Now, that's nothing too outrageous on the face of it. But I have to say, it's really quite a shock to learn that this represented the first time that private renting was actually mentioned at the committee, and it explicitly referenced how it affects on the transition of monetary policy. Why the newfound interest in private rental market as a challenge, as a way of dampening spending?
Well, I mean, another of the structural changes that has taken place in the UK is that the rate of home ownership has declined over recent times, and so the private rental market has become more important. More people are renting. There's been the growth of the buy-to-let market. The other point I would make is that, I mean, I think we also be very, very conscious of this, that the private rental market, obviously it isn't homogeneous, but there is a greater concentration of the private rental market in the lower household income bracket.
So are you kind of worried that increasing interest rates has a disproportionate effect on people who are much poorer?
Well, I am aware of it. I'm afraid, obviously, we have to do what we have to do on monetary policy, because I would say, I've said it quite a few times before, of course, and John was saying it earlier, if we don't get inflation down, then I'm afraid the consequences are worse. But I am conscious of the fact that the private rental market has a higher concentration in the lower income income groups in society, yes.
And the private rental market is about 20% of households across the UK, but in my constituency in South London, it's a third.
Yeah.
The renters I speak to at my advice surgery every Friday are kind of beside themselves about their futures and their possibility of keeping a roof over their head. They tend to be younger, poorer, have more children, and spend an ever greater proportion on their monthly rent than the equivalent homeowners do, but without access to any of the safeguards or security that are involved in owning. London rents are outstripping wage growth as landlords pass on increased mortgage rates to their tenants. Meanwhile, no-fault evictions are at their highest since 2017, and when we see court staff back next month, hell is going to break loose in lots of London councils as buy-to-let landlords want to sell their properties. It's a really precarious position for families who are finding real difficulties. And so the safety net there is falling apart. Fewer social housing units. In my borough, in the last year, there have been 37 three-bedroom properties to let. There are 99,000 families in England currently in temporary accommodation, which cost £1.6 billion to the public purse last year. Are you, back to the point, are you concerned that the transmission of monetary policy is being disproportionately impacted on a group of people unable to fight back?
I am concerned about these impacts because it's important. I can't comment on housing policy because I think there are obviously questions there. But I can tell you, yes, I spent some time with one of my regional visits, as Elisabeth was saying, at a citizen's advice in Exeter actually, and met people in exactly that position and talked to them. And I know that these no-fault evictions are very, very difficult for people.
Are private renters just becoming collateral damage?
Sorry, I just wanted to add to that. I had a really interesting round table when I was in the Northwest with a group of housing associations and small private rental providers, and they certainly felt it was very hard for them to keep up also with some of the regulations and everything. So obviously, as the governor said, we would not comment on housing policies, but it's certainly very clear, and I've seen this in my own family. At the moment, we live in a 4-generational household, and one of the reasons is because for the youngsters, as you said, it's getting more and more difficult to find somewhere to live at within a budget they can afford.
And if, again, we look at house building now, the number of new homes completed in the first half of 2023 was just under 110,600. That's the lowest figure in any of the last 6 years, excepting 2020 due to COVID, and a year-on-year decline of 11%. We know that loan-to-value ratios for new build mortgages are less generous. So it's fair to assume that demand for new build properties will fall sharply as belts tighten even further, particularly given the end of the government's Help to Buy scheme. We also know that small developers who depend on your definition, deliver roughly a third of UK homes, will be disproportionately hurt by the increased cost of borrowing because they have less access to capital, ability to land bank, and typically rely on a project-to-project kind of basis. This is a very bleak outlook for house building in a country which is already under supply of over 4 million properties. What assessment has the Bank of England made of the likely impact of sustained high interest rates on house building in the UK?
Well, we do look at it through the lens of housing investment, which is in many ways obviously a very similar thing. And you're right, I mean, housing investment is weak at the moment because activity in the housing market is weak in turnover terms. This is, I'm afraid, probably, not unexpected given the cycle in interest rates. And I think, again, obviously, the sooner we get inflation down and get some return to that normality, we will get greater confidence for investment. Again, a point I think John was making earlier. Lowering uncertainty tends reasons to raise investment in the economy, both business and probably housing as well. But I can't, again, comment on sort of housing policy more generally, because that's not our...
Are you not concerned that this represents a case where monetary policy to control inflation in the short term is going to come at the expense of worsening a housing crisis could last for generations?
I would just reiterate the point that if we don't control inflation, then things get worse.
Can I extend the invitation to anybody here today to come to my advice surgery on a Friday?
Mm-hmm. Thank you very much, Siobhan. Angela.
Thank you very much. Governor, new lending at terms longer than 35 years is up from 5% in the first quarter of 2022 to 11% now in the first quarter of 2023, which essentially keeps people indebted for longer. Their mortgages last virtually a lifetime, and therefore they incur a bigger interest rate bill. Have you, as a committee, thought about what effects that switch and that change may have on the economy in general?
Well, we do look at it from the point of view of the transmission mechanism of monetary policy, so I agree with you on that. I think it is, again, putting my old hat back on momentarily, I think it is for the FCA, who do have policies, because I remember them being introduced, in terms of ensuring particularly that if people are taking mortgages that are likely to extend into retirement, that they are affordable. And that's important.
But they have little choice, many people now,
yes,
given the different ratios between average wages and the cost of a house, than to do that or face life in the private rented sector, which as we've just heard from my colleague, can be very, very stressful, where you have very few rights and are subject to no fault eviction at a few months' notice. So, I mean...
No, I mean, I think there's a balance to be struck here. I think the flexibility to extend mortgage terms is not necessarily a bad thing for some people at all. I mean, I think it's not a bad thing. But clearly I think it's important to watch that it doesn't become embedded in a way that for some people at least, it becomes difficult. And of course the problem will emerge much later on.
Yeah. And I wondered whether you had thought, or there was any initial work being done on the implications for that in the context in which you work, which is the macro economy.
Well, I think our role in a sense, both from the monetary policy and the financial stability side, is to take account of how it works through the monetary policy transmission and does it affect financial stability. I would say on financial stability, I don't think it's big enough to really register on that scale, but I think the FCA has a very important role to play here in terms of the conduct of these arrangements, which I know they're very aware of.
I mean, we see the FCA regularly, and rest assured that we do ask them questions about this. On the transmission...
I think John, if no one...
John.
Well, financial stability issue here as well. But just a general point. The underlying driver of house price to income growth in the end comes down to supply and demand for housing. And the Bank of England can't deal with that. Our housing tools, the measures that we brought in at the FPC, limited the amount debt to income, the flow of high debt to income mortgages. One of the reasons I think why we've been able to go through a period of very sharp monetary policy increases without creating the sort of housing crisis that we saw in the 1990s or some of the impacts we saw in the financial crisis, is because actually household debt to income is lower than it was. So it's and of course households were tested by the FCA and by the bank whether they could service their debt at a higher rate. So from a financial stability point of view, I mean, if the answer to people not being able to afford their houses is they borrow a lot more relative to their income, then actually you induce a volatility in the macroeconomy and in financial stability, which at the moment we haven't got. So there are questions about the financial stability risk of the mortgage increases, and the FPC's view is there are the mortgage increases it's clearly having an effect on people, but not a financial stability effect. So one really has to tackle the underlying issue here, which is about the supply and demand for housing.
And also I'd add that, of course, financial stability is a backdrop, that we've got a banking system that is in a stable condition, and so the agreement the Chancellor announced with the banks on the mortgage concordat can be done when you've got a stable financial system. And also, as John was saying, I mean, the repossession rate is now nothing like what it was in the early 90s, and that's a good thing.
I don't disagree with you about that. I think, though, that if we look at banking resilience as well as a part of financial stability, which you have to consider, if we look at bank profits, they've risen very substantially in the last period, up to about 17.9 billion, according to the figures I've seen, which is a 21% increase from quarter one this year from the last quarter of last year, a substantial increase with strong net interest income. And this ties into what my colleague Sir James was talking about earlier, which is the refusal or the slowness of the rate of pass on. That damages transmission mechanisms, and it enriches particular banks who might be even accused of profiteering. That's a fair point to make, isn't it?
Well, I would look at it, two things. I would look at it from the point of view of return on equity, because I think that's a more systematic way of doing it. I think for some banks, certainly, I think for quite a few, the return on equity is getting back. It's sort of around now its long run average. But the second thing, and I'll come back to the point that we were making earlier in the conversation, I very much take the view, as I said, that there may well have been a transitional element to this as the interest rate regime changed, but obviously it can't go on. If it went on permanently, then I think we would have big issues.
It's a very profitable lag from the bank's point of view, isn't it? That they haven't passed through interest rate rises to their savers as quickly as they've increased the cost to their borrowers.
They've certainly...
they've made a lot of
net
money.
Interest margins have risen. I think, again, if you look at them in the long run context, they're probably back towards their long run averages, whereas having interest rates at near to zero had moved that. So again, it's comes back to this point about recency bias. What's the right basis of comparison here? Is it the post-financial crisis period when we had an extraordinarily low level of interest rates, or is it the longer run? You'll get a different story depending on which you look at.
I suppose it could be said, given that you're responsible for financial stability, that you're quite happy with banks being more profitable, even if it damages the transmission mechanism. Is there a bit of a bias that way from the bank's point of view?
We, and essentially, and that's why we do stress tests, we look for levels of capital in the system that we think are consistent with maintaining financial stability. We've in a sense set that level, and the stress test then tests against it, and the banks pass the stress test. Now it follows from that we are not seeking to see capital levels higher than that. That's not part of our objective.
It's an interesting response, because the stress test, which we talked about earlier, assumes that banks pass changes in the bank rate through to retail deposits to a far greater extent than they actually have. So does that confirm that there are no financial stability reasons why the banks shouldn't have been passing through bank rate increases much more generously and quickly?
It would be consistent with my view that the rate is increasing, and I'm not surprised. And I think there was very good reasons why it should increase. So that's consistent, I think.
Okay. I'd like to also ask a couple of questions about more broader financial stability issues. We talked earlier about during a year ago when we had the trust budget, improving the resilience of LDI funds, this crystallised issue with pension funds that nobody had really quite realised was there, which suddenly crystallised into a highly dangerous situation. Are you happy with the changes that have been made and the analysis of what happened, to think that has now been dealt with and it's not going to happen again in period of high stress?
Two things. John may sure want to come in on this. Two things that I would say have happened. One is we set a level of buffer which we regarded as consistent with maintaining stability, given obviously the experience of just under a year ago now in terms of what can happen in interest rate markets, and they are doing that. And when we had a much lesser degree of volatility, but still some volatility earlier this year in the markets, they were able to absorb it very easily and deal with it. And so I thought was encouraging. But of course, it needs to stay there. The second thing is the duration that it takes the funds, particularly the so-called pooled funds, to realise the assets.
There was more of an issue with the pooled funds, wasn't there?
It was, yes. Because of the collective action problem that's embedded in them. And again, I think we've been very clear that they have to be able to realise this liquidity within that pace of time, because if they can't, then they default, and that was the situation we faced. Now, again, I think good progress has been made, but we have to ensure that it remains there. I don't know, John, did you want to?
No, I think the buffer we put in place, which was a kind of emergency buffer to deal with the gilt yield rise of 250 basis points, and then, depending on the fund, something to deal with day-to-day movements between 50 to 150. That looks as if it would deal with a historical experience and something on top of that. And that is being implemented now by the asset managers who manage those pooled funds. And as the Governor said, they've managed to keep that buffer there. I think it's going to come into guidance from the pension regulator, so it'll become part of the system to have that liquidity buffer there to deal with it. Equally important is ensuring that you can actually get the liquidity across between the pension fund and the pool fund, and there are some requirements also, the number of days that they should be able to, within which they should be able to get the funds across. So I think it looks as if they are in a much more robust position to very sharp increases in gilt rates that generate liquidity calls than they were before.
The Financial Stability Report warns once again that the sharp transition to higher interest rates, this volatility that we've been talking about, increases the likelihood that market-based finance vulnerabilities crystallise. Now, that was one we just talked about. Have you got your eyes on any others?
Yeah.
Well, can I perhaps say something about real estate? As no doubt you would have been aware, commercial real estate is a topic which many central banks across the world are very focused on, and clearly in volatility of interest rate, or especially an increase in interest rate, it will be much harder for investors in real estate. And for now, let me just focus on commercial real estate to, on the one hand, get the financing, but also make it viable. That would certainly be one area the committee has been very focused on. And then the other one obviously would be volatility can obviously be a good and a bad thing for certain market participants. So if you think, for example, another pocket of the financial sector in terms of non-bank finance, say the hedge funds and that area.
They thrive on volatility.
Well, yes. Having said that, one of the things
up to a point.
Yes, up to a point.
You might even say they cause it, but that's a different issue.
Yeah, well, you may be aware that the bank, and in particular the Financial Policy Committee, has launched, there is another nice acronym here, the SWES, the System-Wide Exploratory Scenario, which particularly is looking at non-bank financial institutions. So remind me, when is that coming up? John, you probably have it on top of your head. Later this year, I think, right? So,
scenario.
Yeah, this scenario, yeah. So obviously you're seeing Sarah Breeden next week, and she'll no doubt will be able to talk more about that.
Well, I want to just ask my final question to Sir John, given that it's his last time here and we go back rather a long way. The Financial Stability Report highlights in chart 5.5 that hedge funds have built up large short positions in US Treasury futures. Can you explain the potential risks arising from that and what the UK can do to protect itself if they crystallise?
This is the riskless trade that sometimes goes wrong. we saw this in the Dash for Cash. So basically what hedge funds, or some hedge funds, the relative value basis trading that the hedge funds do, is basically the asset managers want to have an interest rate future, an interest rate derivative. And what the hedge funds do is they buy the underlying government debt, so they'll buy a US Treasury or a gilt. It's mainly a US trade, this. They'll buy a US Treasury, and so they've got the US Treasury which will pay out at maturity, etc. So in a way they have that interest rate flow, and then on the back of that they'll sell a corresponding derivative contract to an asset manager. And generally there shouldn't be any difference between the underlying instrument, the US Treasury, and the derivative which is based on the underlying instrument. However, during the Dash for Cash there was a difference, and the problem with this trade is you don't make very much money on any individual trade, because basically you're trying to sell something while holding the thing it's based on, so it's very small margins. So in order to get return on that, you leverage up very, very highly. And then if something goes wrong and for some reason the price of the derivative you've sold starts to diverge from the instrument on which it's based, which in theory should never happen, but it does, then suddenly you get very large margin call, because you have to actually pay the difference that's happening, and also you reach solvency issues. And if you've borrowed money, because you have to leverage up from your prime broker, your investment bank, to do that, and they start to get worried and cut off your lending, then you have to start selling the underlying instruments very fast. And one of the drivers in the Dash for Cash, and it's the US Treasury has done, the US authorities have done work on this, but one of the drivers in the Dash for Cash, and by the way, the hedge fund industry disagree with me on this, so there are other views, but one of the drivers, and it was not huge, but it was acute and very concentrated, was the hedge funds that were in these trades suddenly having to dump an awful lot of government securities on the market, and that's what helped drive some of the spiral that we saw in 2020 in the crisis in funding markets, US Treasury market and the gilt market. And what we're signalling there is that those positions have been built up again, that people are back in that trade. And I think the answer to that is partly to do with the cost of the leverage to the hedge funds from their prime brokers, and that's something we've been looking at in this whole area of fund leverage, and we're looking at sort of internationally. There's an argument that in good times this trade actually keeps the price of the future tied very closely to the price of the underlying asset, stops them ever moving very far apart. But in stress, so that's a very long tick here, but in stress it can cause problems, and that's one of the areas we're looking at.
Thank you. Thank you very much. John, I think you had a few supplementary questions.
Yes, just very briefly. Can I just take us back to the issue of, you said, Governor, the importance of risk-taking in an economy, and one of the objectives of the Bank of England is to support the economic policy of the government when it comes to growth and employment, quite rightly so. And I refer colleagues to to the Register of Interest, but we have a scenario where the regulatory authorities in this country seems to have gone into overcharge and are dampening growth and employment. I'll give you one specific example, and maybe Sir John can come in on this, given his knowledge of financial matters. But we have investment trusts in this country which have been conduits for tens of billions of pounds.
Do you want to declare your interest as well?
Sorry, I thought I had declared my register. I've got interests. I'm particularly interested in investment trusts. And my interest, as you well know, I apologise, I thought I had said it. Investment trusts have been a brilliant conduit for investment in things like renewable energy and infrastructure, private equity and so forth. But they're being now disadvantaged by FCA guidance, which requires them to add their corporate costs, i.e. management costs, administrative costs, financial costs, to the fund manager's charges, even though these costs are already captured in the share price. The market makes its mind up with regards to such charges. And we now have a point where Britain is therefore the only country in Europe which is retaining these cost disclosure rules. No other country in Europe is doing so. And this is putting off, this double charging in effect of the management of the investment trust and then the management fees for running a portfolio of trust, is putting off investment. And we've seen the amount of money raised through IPOs for renewable energy, for infrastructure, for many others, absolutely decline and discounts widen. I mean, is this something you're concerned about? That, that is not financial stability, that is overbearing restrictive practices to the point where the only person in Europe doing it. What is the bank going to do about it? And would the bank look at this?
I think, as you say, what I would say is I am concerned for the reason that, as said earlier, is that we are very interested in, obviously, in the underlying growth rate of the economy and the supply side of the economy. And that, of course, has to be supported by investment, which will support productivity growth. Now, I can tell you, as I'm sure you're aware, that the Chancellor is very interested in this subject, and there are a number of initiatives going on, and I would sort of strongly encourage you, if you haven't, to have that conversation. I can't speak for the FCA, and I think it's one since my time, but I can't speak for them. If I'm wrong on that, I apologise. But I think it is important. I mean, we had the same issue with Solvency II, and it's well-known, obviously, process that we had to. You have to balance what I call policyholder protection and investment in the economy, and where those are matters of judgment.
I would like to bring Sir John into this also. I do know we do know what's going on in the wider. We've got the Edinburgh reforms, we've got the Mansion House Compact, we've got various things being looked at by various individuals. But still, the Bank of England has a responsibility for encouraging growth and employment, or helping the government achieve that, whichever government it is. And yet, the signalling from the Bank of England, if I may suggest, has been somewhat weak. Here we have the FCA actually restricting what has been in the past a very growth-orientated part of our financial system. You will appreciate the importance of investment trusts to the economy. We've got 4 investment trusts in the FTSE 100, for example, and 100 plus in the FTSE 250. They've done a great job in channeling money into growth areas, important areas for the country, renewable energy infrastructure, and yet the FCA has gone out on a limb within Europe generally to enforce a cost disclosure regime, which is enforcing investment trusts to do something that doesn't happen anywhere else. Now, what is the messaging from the Bank of England on this?
I can't speak for the FCA. I think you need to raise it with the FCA.
No, I know you can't, but it's still, you're still there responsible in part for regulation.
I strongly recommend you speak to the Chancellor, who's very interested in these subjects. I'll be honest, we have put our sort of focus of late on the question of pension investment, starting really with the productive finance work that John Glenn led, but going forwards in terms of how, a pension fund investment can be mobilised in the economy. But I take your point. I mean, there are more angles to this issue, and I would strongly suggest you raise it.
Thanks, John. I'm going to bring in Andrea, I think, to get back to the...
Thanks. Yeah, just one last question, really, from me, which is, does the Bank of England or Monetary Policy Committee consider it has any part of its remit to avoid a recession?
Well, our remit is to maintain inflation, return and maintain inflation at its target, and subject to that, support the policies of the government. And of course, those policies include policies on growth, investment, sort of things we talked about, and that's what we do.
Okay, so no then?
Well, we're not seeking to create a recession.
No, I'm not really challenging on whether you're seeking to create a recession, but it's just going back to this risk of over-tightening again. You may well create a recession. You don't know if you'll create a recession, and so your only objective is to get inflation down, not to avoid a recession. So I'm just really reflecting on your answers to my questions and wondering whether under the terms of the obligations of the MPC, is it fair to say that because you have to get inflation back to 2%, that is your mandate, it is worth it to you to risk a recession because that is not part of your mandate?
Let me answer that question.
No, I'd like you to answer that question.
Well, I'm going to. Let me illustrate it. We have certain flexibility over how quickly we return inflation to target, and clearly that would have consequences in terms of, I suspect, in terms of outcomes for growth in the economy. And we do balance that. We think currently that inflation will return to target somewhere just after the turn of the year at the end of next year. We're not seeking to do it more quickly because I don't think that would be optimal from the point of view of the path for the economy as a whole. So we do consider that, yes.
I'd go, if I might, I'd go...
Sorry, I just really would like an answer to the question. So you wouldn't raise interest rates and risk a recession? You wouldn't have in the back of your mind?
We do have to make a choice. I mean, let's say, you know, hypothetical world for a moment, we could return inflation to target, you know, middle of next year, or we could return it to target at the end of next year, and there would be differential outcomes in terms of the path of growth in the economy and the recession. We would have to consider that very carefully, as we do.
Dr. Dhingra, what would your answer to that question be?
I would say actually a recession poses real risk to our inflation target in itself. So that's just sort of not something we would like to have happen at all.
Right, thank you.
Our remit is to hit the target sustainably, to bring inflation sustainably back to target. So if, for example, we were to create a recession kind of immediately by very large increases in interest rates, then we would find inflation is below target at the horizon, and our target is symmetrical. It is to keep inflation at 2, caring as much about under as over. So as has been said, Swati said, we have to balance those various things, and that's why the forecast always at the end looks at where activity will be at the end of the horizon, but it's sustainable too, not just 2 at any given point.
Can I just qualify that, if you don't mind? I mean, in one respect, if you go back nearly just under a year ago towards the later end of last year, we were forecasting a recession because with energy prices where they were at that time, I'm afraid our conclusion was that, you know, in those circumstances, it was going to be very likely that that's what would happen, and we couldn't avoid it. Now, fortunately, of course, the energy price story, you know, evolved in a very different way. So I agree with John and Swati, but I would emphasise we can't always say we will avoid it.
I understand. It's just my question was more about your motivation.
I may add one line to that. So I think what the chair raised earlier about non-linearities becomes really important at that point, that how quickly things deteriorate, it's very hard to get a handle on that.
The remit is actually clear about when we are in so-called trade-off territory, when we have to trade off the speed at which we bring inflation back to target relative to what happens to activity. The remit gives us the flexibility to extend that period to try and to avoid that. But there is there's a great speech by Mark Carney on Lambda, if I can call it that, which actually explains how the remit delivers between those two things.
Okay, I think, Anne-Marie, you had a supplementary.
I did.
Yeah.
Following on the questioning about mortgages and the concerns which Ms McDonald rightly raised, I think, can I just ask with regard to buy-to-let mortgages, why is it that there is an obligation when the product is created to build in a greater, if you like, cushion for risk, and therefore they're generally offered at a higher rate? So the cheapest buy-to-let mortgage I think you can get at the moment is 9%. But when you look at the data, historically, there is no record of buy-to-let mortgages being riskier with greater levels of default. So it seems to me all you're doing by requiring that inbuilt cushion is increasing the risk that was referred to earlier of landlords rushing to the door and selling.
And Anne-Marie, just to clarify, do you have any interest you want to declare in the context of this question?
I do have a property to rent. You're absolutely right. Yes.
Yeah.
Two things. They are much more heavily concentrated as interest-only mortgages. So, on the whole, the level of equity will be lower. Secondly, this goes back to obviously the recency bias again. We have not got a very long history of buy-to-let mortgages, so that again the modelling that's done to create those risk weights has also to look at the risks, and particularly again that's where the 2 points come together. Really, is to look at the risk of having these mortgages with often much thinner levels of equity in them.
Does that answer your question?
Yes.
I have a couple of further supplementaries that I was hoping that perhaps colleagues might raise, but on quantitative tightening so far, you know we have an open inquiry into quantitative tightening.
Yes.
To what extent has the quantitative tightening that you've done so far tightened monetary policy? Do you know now what impact that's had?
On the basis of what we've done so far, we don't think so to any great extent,
Yes.
but the staff are working on the subject, so I will ensure that any staff work, any staff work that we think is useful, we'll send to you.
Do you think that mortgage rates, for all the people out there who are worried about the increase in mortgage rates, do you think mortgage rates are any higher because of the quantitative tightening that you're undertaking?
No, I mean, that's in a sense saying is the interest rate curve higher than it would otherwise be, because as I was saying earlier, they're priced off the swap curve, so that's the price. And our analysis would suggest no, that quantitative tightening has not contributed to any notable increase in the curve. But again, we'll be happy to send you what I'll make sure you've got what we've done, so that you see the work that we've done on that subject.
You don't think that the current level of mortgage rates is affected by the quantitative tightening programme that you're undertaking?
I don't think so. And I have to say that when we take our judgments on what we would do going forwards, if I felt it was, then I think we would have to think very seriously about the implications of that.
And nearly a year ago, we went through turmoil in the mortgage market, and then things seemed to stabilise for a period, but nevertheless mortgage rates today are similar to what they were in that period of turmoil. Is the level of mortgage rates today connected to your actions in terms of tackling inflation and raising rates?
Can I go back to what I was saying a few minutes ago? Because if you go back to this point, as you said, just under a year ago, we were forecasting a recession. So we had interest rates at that level with a forecast of recession. As we said earlier on in the hearing, the record and the evidence on activity in the economy has shown it's been much more resilient to that. But that does affect, therefore, I think has affected the setting of interest rates and where the market is pricing rates. But as John was saying, in a very different setting of a more resilient economy.
So the rates that those who are worrying about the increase in the mortgage amount that they have to pay, is that connected to the increases in rates that the bank has implemented since last year? Is there a connection between higher rates and higher Bank of England rates?
Yes, there is a relationship.
There must be.
Yes, is the answer.
Come on, you're not going to deny that.
No, because there is of course a relationship. If you look at the sort of the 2-year, let's say take 2-year fixed rate mortgage. If you look at the relationship between our setting of bank rate and the 2-year point on the curve, yes, there is a relationship. It's not a one-for-one relationship, but there is a relationship. Yes.
But the turmoil period just under a year ago, is that still reflected in mortgage rates today, or is it more linked to what?
No, I think most of that. I think most of that came out in the months following. So I think what we're now seeing is a story that's much more about the resilience of the economy.
Okay. And then one final question, and so John, you alluded to it about the ONS and that they've revised up UK growth over the period where inflation became so high in the UK by, I think, 1.8% cumulatively. And I just wondered if even the Statistics Authority can't tell you what the current rate of economic expansion is, that must make your job really, really difficult. Or do you feel that your approach, which is independent, obviously, of what the ONS are doing, has correctly captured the level
let me say two
current
things on that. John might want to come back. Swati might want to come in. So first of all, I would just point to the fact that for a long time, actually, a lot of years actually, if you look at the 3 fan charts that we published, the GDP chart, the unemployment chart, and the inflation chart, for one of them, the GDP chart, we actually have a fan on the historical period. So we have a backdated fan. And we don't on the other two. And that's because GDP data do get revised. So there is uncertainty.
Big revision, wasn't
it? Yes, it was a big revision. But there is greater uncertainty on the GDP data, and that's reflected in the fact that we have a fan going backwards. The second thing I would say is that, as John was saying earlier, this relates to 2021. So if you like, the evidence we're seeing today, so the nominal evidence we're seeing today, so let's take inflation, for instance, of course, is a reflection of what I called, in inverted commas, the true state of the economy. I mean, that's a product of the economy. What the ONS are telling us is therefore is a sort of revision to what we understand to be that true state in the past, not the true state itself. And it helps us in a way. John made this point earlier, because we've been telling a story about the fact that we think the economy has been more resilient than we expected it to be. And of course the revision revision helps with that story. I think there are also some points which I know are quite specific about how public sector activity is measured in the UK. That there is a difference. I remember when COVID broke out, I think the health sector in this country, activity is measured by counting procedures, as it were. The problem during COVID was that the procedures that got counted stopped happening, and obviously the health sector was doing a
very busy.
Huge amount of stuff, but it wasn't getting captured easily. And I think the ONS have gone back and looked at that again and revised the view of what actually went on.
But in terms of your decision?
No, well, we will look at it, as John was saying earlier, we will obviously look at it very carefully, don't get me wrong. But the nominal data that we see today, 2 years after those revisions, will of course reflect what's actually happened in the economy, not how the ONS measure it at the time, if you like.
I think the interesting question is, had we known at the end of 2021 that the economy had actually come out of the COVID period much more strongly than the official data was saying, would we have taken different decisions? Over the sort of period that followed, we started to take our own decisions based on what we could see in the economy on surveys, and increasingly, as I said, have written more demand in than you might otherwise have done. But
you think that you wish you'd known that at the time?
Well, yes, but on the other hand, I have huge sympathy for a statistics agency trying to measure output of an economy that has been shut down 2 or 3 times over a pandemic, with very different economic activities. So this goes back to some of the points we were making about how you forecast, how you measure through these periods that are outside your historical experience.
Right, any other points that any of you want to land before we come to an end of the session? Dr. Dhingra.
Quick point about the revisions, which is that the 2021 revisions, a large part of it also has to do not just with the services, but with what happened to consumption of intermediate inputs. And that's something which in the cost of living crisis is really critical because we're buying a lot from outside. So what happens with the 2022 numbers, it's not very clear which way that would go. So that's something to be kept in mind. And I just want to say one thing, which is that, of course, it muddies the waters, not knowing precisely what's going on in the economy. And I've written a lot about this in speeches as well, that a really good data infrastructure, if that's one lesson we're going to get out of this pandemic and the cost of living crisis, that really is it, that we need to have a much better data infrastructure.
Yeah, thank you.
I'd really, if you don't mind, just like to finish by echoing what you very kindly said and put on record my thanks to John for his enormous service to this country.
That was going to be my concluding statement.
Oh, I'm sorry.
But I do want to wish you, John, for everything that you do. This is your final appearance here as Deputy Governor, and thank you for your public service.
Yeah. Thank you very much.
Order. That concludes our evidence session.
Thank you.